Let's welcome on board Anshul Saigal as well and find out what he's making of the market right now. Anshul, hi, afternoon. Let's pick it up from, what we heard from Puneet Chatwal from IHCL. After what seemed like an inline Q1 because of the monsoon quarter perhaps, which is going to flow through in Q2, who do you think is going to win the battle, and whether or not you think hotel industry has a prosperous rest of FY25 ahead of them?
Hi, Aisha. Pleasure to be with you. So for the if you go back to the 2003 to 7 cycle, and you look at where rates went around the time of 2007, 2008, we are still scraping only the surface in hotel tariffs at this moment. Even though occupancy is high, hotel tariffs are also up, but in comparison to where they were in that phase, we are nowhere close. So I do anticipate that this is a rising tide for the entire sector, as we know that it takes at least 2 to 3 years to set up a new property. India is short of properties. Demand is far higher than supply at this moment, which will mean both pricing as also occupancy will be favorable for this sector. And this is a game of scale, which is why companies which have scale and that reflects also in resources, that is the balance sheet and the capital available to these companies. Whoever has scale, that company will really rake it in this cycle, and they will also there will be consolidation in this space for sure in the years to come. Some of the companies will be absorbed by the bigger players. So, to your question, who will be the winner here? I think that one should stick with the larger companies, the more efficiently managed companies, and companies with the franchise, with a brand which the consumer kind of appreciates and looks forward to staying in. I think that's the space which is going to benefit going forward.
Enough. That's the view coming in. Anshul, hi, Anisha this side. Just wanted to get a sense from you with respect to how IT stacks up, because HCL Tech, Infosys, TCS got the street excited, but then came the likes of Wipro, even Persistent for that matter, and now it's unwinding a bit. What's your view?
Hi, Anisha. So as regards the IT space, while in earnings terms there have been slight beats for the large companies that you mentioned, some companies, of course, have disappointed, but the mid-cap one that you mentioned, which is Persistent, for nearly the last 3, 4 years, it has outperformed the sector. And this is in times of real headwinds in this space that this company has been able to outperform on revenue growth as also margin expectations. So one quarter here or there really doesn't matter. Of course, valuations have caught up to levels where they've never been for the space in general and for this company in particular. Even for the larger companies that you mentioned, these companies used to trade at sub 20 times price to earnings multiples. And now, despite some sort of a consolidation that this sector has seen, these companies still trade at 25 to 30 times price to earnings. Now, that is by no means an attractive price to be looking at going into this space aggressively. Of course, there are expectations being built that US interest rates will be cut, which will mean that there will be tailwinds on demand from there. And hence, this is an attractive space to be in. But in our judgment, most of the upsides or the expectations uptick is already in the price, which is why it is, to us, it is really not an attractive space to be in. But I speak as an individual investor. For portfolio managers, it's a different ball game altogether.
Anshul, of the earnings season so far for financials, there was expected that there's going to be a slowdown. There is that. But overall, the commentary suggests that perhaps the credit growth this year is not going to be as stellar as we're used to.
Times, of course, credit growth, Anisha, has been quite strong in the range of 15 to 20%. Last month, it has kind of decelerated from the previous month, but the base was higher. It was at around 20% and come down to about just under 15%. I think that what is happening at this moment is while retail and SME are holding the ball, as also to some extent rural. Um, Private, corporate credit, that's really not picked up so far. That's still sub 10%. I think that just like one of your commentators, I think the Thermax CMD recently mentioned on the show that they anticipate that there is going to be investments in private capex going forward. This year could really mean the turn or bring the turn in private capex, and so that will mean that that leg, which has been slightly weak for banks, that may start picking up. Also, the results season so far has been mixed. Some companies have delivered strength in growth, others have kind of lagged. But really, this is not a 1 quarter, 2 quarter story. I think that if India has to grow, and in the next 5 years we're likely to be double in GDP size as we are today, then the banking sector is going to be a huge beneficiary, and the one should really buy into quality names and just sit on them for the next 3 5 years. If you give me a minute, I'll give you an anecdote, a very interesting one. Someone sent me a clipping recently saying that HDFC Bank has delivered over the last 30 years 22% compounded returns. Now, I, out of curiosity, tried to check how much that means in terms of returns. So if a crore of rupees would have been invested 30 years back in HDFC, it would be 500 crores today. And I'm not exaggerating. That is the number. So 500 times. On a 10-year basis, that number would have been 8 crore rupees from that time to the 10 years thereafter. So compounding is what one has to benefit from. And in this space, given where the country is, what kind of credit growth we are likely to see, I think that banking as a space looks quite attractive for the next 3 5 years.
Anshul, good to have you on the show. We'll let you go on that note. Kunal, a quick take on what to.
If you like this video, then like, share and subscribe to ET Now.